If you've spent any time at all in Kathmandu, you know the scene. That rider in a bright jacket, phone mounted on the handlebars, weaving through traffic. It's everywhere. It feels like the future, like explosive growth. But it also begs a really big question.
Yeah, behind all that hustle and all that activity, is anybody actually making money? That's the core question we're going to tackle in this explainer. And believe me, the answer is way more complicated and frankly more interesting than you'd think.
So we're not just going to skim the surface here. We are going to perform basically a strategic autopsy. We're going to open up this business model and really dissect the economics piece by piece to figure out what is really going on under the hood.
Okay, so here's our game plan. We'll start with the absolutely crushing math of just one delivery. Then we'll look at the big gamble on electric vehicles. After that, we'll talk about why the market has to shrink. And finally, we'll reveal the real prize that everyone is actually fighting for.
All right, first things first. Let's follow the money. Forget about those huge company valuations for a second. Let's zoom all the way in and just look at the brutal economics of a single order.
So let's say you order some food. The platform charges you a delivery fee, right? A typical one might be around 150 Nepali rupees. Seems reasonable enough as a starting point.
But here's the first problem. Right off the bat, the vast majority of that fee, often something like 80% or 120 rupees, goes straight out the door and into the rider's pocket. You have to keep them on the road.
So what does that leave the platform with? This. Just 30 rupees. And from that tiny slice, they have to pay for, well, everything else.
And this is where that 30 rupees just gets obliterated. You've got the cost of ads and promo codes to get you to order in the first place. You have to pay the engineers who built the app, the people in the support centers. The list goes on and on. When you add it all up, that 30 rupees is gone. They are almost certainly losing money on every single delivery.
So why on earth would they do this? Well, it's something called the volume trap. The whole strategy is to lose money now, but get so incredibly huge, so dominant in the market, that you can somehow, somewhere down the line, make it all back. It's a really dangerous game that only companies with incredibly deep pockets can even afford to play.
Okay, so faced with these terrible costs, a lot of these companies are looking for a savior. And for many, that savior looks like an electric vehicle. The idea is simple. Attack the rider's biggest cost, fuel. But is it the silver bullet everyone is hoping for? And you can see exactly why the idea is so tempting. I mean, look at this. A petrol scooter costs more than 5 rupees a kilometer to run. An electric one, just 1 rupee. The potential savings here are just massive. This could completely change the game for a rider. But of course, there's a catch. You're not just saving money here. You're fundamentally shifting your entire cost structure. You're trading those manageable daily fuel costs, what we call operating expenses, for a huge one-time investment in the scooter itself. That's a capital expense. And the really important question is, who pays for that? The rider? The platform? And going electric brings a whole new set of headaches. We're talking a huge upfront cost for the scooters, the logistical nightmare of managing a fleet, charging them, maintaining them, and you're suddenly completely dependent on a charging infrastructure that's, well, it's still pretty new in Nepal. A simple power cut could literally grind your entire business to a halt.
So with all these economic pressures, what does the future of the market look like? Well, one thing is for sure. The current situation, with more than 10 different apps competing in Kathmandu, is just not going to last. It's unsustainable. And that's because there are two powerful economic forces pushing this market towards consolidation.
The first one is called network effects. It's a pretty simple idea. The more customers who use an app, the more restaurants want to be on it. And the more restaurants that are on it, the more customers want to use it. You see? It creates this powerful, virtuous cycle, a kind of gravity that just pulls everyone towards the market leader. The second force is economies of scale. Think about the massive fixed costs, like building the app or running a big marketing campaign. For a huge company doing tons of orders, that cost gets spread so thin it's tiny on a per delivery basis. But for a smaller rival, they have the same big costs, but fewer orders to spread them over. The big player is always going to have a lower cost structure. You just can't compete on price. So when you put these two forces together, network effects and economies of scale, you start to see what's really going on. This is not a friendly race where everyone gets a participation medal. No. This is a high-stakes death match, and in the end, there will only be 1 or 2 giants left standing.
And that brings us to the final and honestly the most important part of this whole autopsy. If the delivery itself is a money loser, what is the actual goal here? What is the real prize everyone's fighting for? Because I can promise you it was never, ever about that 30 rupee margin. If you look at the two biggest players, Pathao and Daraz, you'll see they're coming at this from completely different directions. Pathao started with ride-hailing, so they own those high-frequency daily habits. Daraz comes from e-commerce, and they have the deep pockets of their parent company, Alibaba. They have different strengths, but make no mistake, they are racing toward the exact same finish line.
And this right here, this is the playbook. It's a 4-step plan. Step 1, get on everyone's phone by losing money on services like delivery. Step 2, weave yourself into their daily habits, commuting, meals, you name it. Step 3, integrate payments so you control the flow of money, and crucially, gather all that data. And then, the final, most profitable step, cross-sell them high-margin financial services, things like loans and insurance. That's the end game.
So let's be really clear about what we're seeing. The fight on the streets of Kathmandu isn't really about food or packages. It's a war to control customer data and financial behavior. The race is on, and the finish line isn't a doorstep. It's a bank. The winner here won't just be a logistics company. The winner will be Nepal's next digital bank.